Hi, it's Nash from AlphaFi, and today we're going to talk about a question I got from a client, which was, hey, can you show me a smaller policy? A lot of the policies shown are large, $100,000, $50,000 per year, and I'd like to see what smaller amounts can be utilized. So I'm going to talk about some of the limitations there and how these look in comparison to the much larger numbers. In general, you'll find that for the most part, they are very similar, just scaled up and down. We try and hold the same design for maximum cash value, maximum flexibility, and maximum growth over time. However, there are a few limitations I want to discuss. So those limitations are what's called the minimum base face amount of insurance. That's kind of one thing that doesn't exist with the larger policies in most cases. And what this means is companies will have different minimums of whole life insurance death benefit that they'll put in force. And so what that minimum whole life insurance death benefit relates to is the base premium. And that's kind of what we want to be a small portion of the policy where 10% or less of our money is going into base premium and the rest, or 90%, is going into PUAs. Hear me talk a lot about that. So you'll hear this called the minimum base face amount or the minimum amount of whole life insurance. And with Guardian, it actually varies based on the health rating. So right here we have their health ratings: preferred plus, preferred, standard, and then you have rated, basically lower than standard. It's called rated, the rated table. And preferred plus is minimum base face amount. Minimum whole life insurance is $250,000. The preferred health rating is 100,000, and then the standard health rating is 25,000. And I don't just want to tell you, I want to show you. So this is a glance at some of the top Guardian products. Whole Life 95 is really good because it provides high early cash values and good long-term growth. And then the minimum face amount here, what I was talking about, is that 250 for preferred plus NT, 100,000 for preferred NT, and 25,000 for all other classes, meaning standard and rated. So we're going to jump back here. So what I did was go in for a 50-year-old male and look at what base premium dollar amount would relate to these minimum base face amounts. So you see those here, and they actually vary quite a bit, because 25,000 is 10 times less than 250,000. So you see that it's not exact, but the two base premiums here are about 10 times difference of each other, and then preferred's in the middle. So then you can look at your PUA contribution max, which is 10 times the base premium for Guardian, meaning you could contribute 10 times these amounts into PUAs. And then the total funding would be those two numbers added together. So it's very different here, kind of the amount you can put into policies given that health rating when looking at smaller funding amounts. So the big question is, well, if I want to do something that looks more like these numbers over here, 778 kind of minimum base premium, and 7,000 to 8,000 kind of maximum PUA contributions, what does that look like? Does it hurt the performance? And so I put that together right here, and I actually put together a 10-90 split policy, 10% going to base premium, 90% going to PUAs, as well as a 30-70, keeping the base premium the same, but just contributing less to PUAs to kind of see, well, if you don't want to put in up to that 8,000 amount, you want to put less, what does that do to the performance? So let's look at these. So on the far left here, you'll see the minimum payment, and it's the same in both cases. And what the minimum payment is that base premium of $700 and so dollars, plus the minimum amount going to scheduled PUAs, which essentially keeps that rider attached. And then unscheduled PUAs is the flexible amount that you can put in at your discretion. So that's why the minimum payment is a little more than the base premium. It also covers the one-year term insurance rider, which allows for raising the death benefit to raise that MEC limit to allow for us to put in a substantial amount of money in an efficient way. And then that target payment right here. So this is the total, including the unscheduled PUAs. We have our cumulative outlay, and then the guaranteed cash value and death benefit and dividend scale cash value and death benefit. Now it looks very similar, right? 8,558 in, cash value coming back is 7,114. This is 83% coming back to cash value. This is very similar, 83, 84%. If this was, a policy that's 10 times as large, it would be very similar in terms of the ratios. So actually the standard health rating hasn't really impacted us all that much from a year one standpoint. The reason is we're maxing out those PUAs, and so really the drag on that base premium, where it's going to be a little more costly, is not as much of an impact to the policy because of the 10/90 split. Let's go back over here. So you would imagine with a preferred plus versus standard, if these death benefit amounts are 10 times the difference of each other, you see how these two numbers are not exactly 10 times as much. And I'll just do that real quick. 10 times 778 is 7,780. You see there's a little bit of I'll call it a discount or a less charge for the higher health rating in the preferred plus scenario. And that's just because essentially based on the tables and things looking at how long folks live and stuff like that, you're getting a little bit of a discount because they're expecting you to live longer. So that's kind of the difference of the mechanics of it. All right, then we continue on here, another 8,558 in, so 15,458 in cash value, almost overcoming those expenses, but not quite. Then we do in the third year, so another 8,558 in, 24,056. So this was actually in addition to the 8,558 you put in, you get that back in cash value as well as an additional $40. And then the next year it grows even more and more and more. And then by year 6, you've put in 51,348. You have more than that available to you in cash value. You have 52,363 on the dividend scale. And then it begins to compound and grow from there. And I modeled a reduced paid up out here. And you can see the net IRR jumps up to 4.6% and continues to grow. So in this scenario, 59, let's just call it about 60,000 out of pocket total. This is a 50-year-old male. So by age 70, they've got 116,000 in cash value, 172,000 in death benefit on the dividend scale. If we continue out here, that climbs to 174,000 in cash value, 218 in death benefit, and it'll continue to grow at a much more rapid pace with a much larger number of compounding out here. Now let's look at the difference of basically doing a 30-70 split. So that minimum is the same because we can't squeeze it any lower because it's already at the minimum, but we're essentially contributing less into PUAs. We did drop the death benefit in anticipation of that because we don't need to pay for a higher MEC limit if we're not going to fund that out. So 55,000 death benefit versus 145, but we're putting 2,600 into total into the policy. So year one, you have 1,684. So that's a bigger hit to your liquidity. So more base premium dollars compared to PUAs going in, 30-70 split. So there's going to be a larger hit to your liquidity because the PUA contribution is less, but not bad. I mean, if we were looking at a 100% base premium policy, it might be a couple percent coming back to us, which would hurt a lot more. Then the drag on the policy, you can see these negative IRR numbers extends one more year, 1 or 2 more years. And then by year 4, we've got more money than we put in to the policy. So 2,600 in, we've got $25 more coming back to cash value on the dividend scale. And then when we get out here, we break even in year 8. And then the IRR, once we reduce paid up, is actually the same because all those premiums get cut from the policy, and it's really just the growth going on those cash values interest and dividends buying more PUAs, and so it is effectively the same at that point, but it's just compounding on a lower number. So 18,200 over 7 years put into this policy. We break even in year 8. We have more money in cash value than we put in. The guaranteed break even is further out as well because we're contributing less to PUAs. But let's look at age 70. So we've got 33,000 in cash value, about 50,000 in death benefit. And then age 80, 49,000 or 50,000 almost in cash value, 62,000 in death benefit, but only 18 grand, in change put into the policy. So still not a bad option, much lower outlays that is possible. Just wanted to communicate the limitations when we get to the lower numbers of those base face amounts. You'll notice that this is on a 50-year-old male. If this was a 25-year-old male, those minimums would be, the minimums would be the same. The minimum base face amounts would be the same, but the minimum base premiums would be less. The reason is they're expecting you're going to pay from, this is an L95 product, from current age until age 95. So those payments are spread out and amortized over a much larger time frame. Therefore, they're going to be less, respectively. So younger folks could expect lower ratios and outlays. If you're older than 50, you could expect these numbers to actually be higher. So good thing to note when considering this for your own personal situation. All right, I hope this was helpful when looking at and considering lower outlays and some of the limitations to consider. Let me know if you have any questions. Please smash that like button, hit the subscribe, and I'll talk to you soon. Thanks.
If you enjoyed this video, please like and subscribe. Also, you can learn more at alphacrusaders.com at the link at the end of this video.